Welcome to the Alvarez and Marshall Middle East Tax Podcast, and today we're going to talk about free zones. My name is Dopmeijer, and I'd also like to introduce you to our team who is joined by me today.
I can go first. My name is Hani Abdul. I'm an associate within the corporate income tax team based out of Dubai.
Hi everyone, I'm Alexandra Nwanze. I'm a manager in the corporate and international tax team here in Dubai.
That's great.
So Tim, UAE free zones, where did it all begin?
Well, it began in about 1985 with the Jebel Ali free zone. It started off as a logistics free zone. At the beginning, there was only a couple of activities that you could do. That was mainly logistics, bringing the goods, modifying them. You had an exemption from customs. You could do a re-exportation of the goods. Nowadays, you can do a whole lot more in the Jebel Ali free zone, including some oil and gas related activities. There's food and agriculture business that you can conduct, a wide variety of logistics services. So it's obviously Jebel Ali port is one of the biggest ports in the world. So it has a big logistics component. Having said that, that was only the first free zone. After that, there were about 40 others, or in total there are over 40, I believe. They all have their own function. They all are governed by their own rules and regulations. Free zones were not taxed. We're going to dive into that and how it may have changed or not. Yeah. Does that answer your question?
Yes, thank you for sharing the history of UAE free zones, Tim. So I guess now with the introduction of corporate tax in the UAE, how has the free zone regime changed?
Yeah, that's a good question. We have only UAE corporate tax since recently. It started off with financial years on or after 1 June 2023. Only those financial years are subject to tax in the UAE under the new corporate tax regime. Before that point, there was limited direct taxation in the UAE. There were only branches of foreign banks that were subject to tax, and upstream activities in related to oil and gas, mainly oil, obviously, was taxable. So the free zones, they had emirate level decrees, which basically said there is no emirate level taxation in my free zone. And that was then a concession, which was often for 40 or 50 years, sometimes even longer. It could be a renewable concession. So long story short, in the past, there was no tax in the free zone. And that could still be the case for the most part, even today. But I think that we're going to explore how that now currently works in today's podcast.
So under the corporate tax regime, Hani, what are the free zone rates?
Yeah, of course. In terms of your question is more about the rates that are applicable to the free zone.
Yes.
So let's generally talk about the free zones. And yeah, definitely. I mean, the free zone is compared to mainland, the free zone has its own rules, but that's only applicable if the entities or the businesses that are operating from that free zone, they maintain. There are certain conditions that they have to maintain, and this is when it will be. The difference will come from. And if we want to talk about the free zones, so we can say that all entities or businesses that are operating from the free zone, they are considered or deemed to be a qualified free zone person, but they have to meet conditions. If they didn't meet these conditions, they will be unqualified to be, they will be out of the free zone regime. And of course, some of these conditions include they have to maintain substance in the free zone, they have to derive qualified income, and also they have to meet the de minimis test. There are other conditions, but this is some of the conditions. Now, let's say these entities or these free zone persons that are operating from the free zone, they met these conditions, then they will have 0% only on their qualifying income. And of course, if let's say for any reason they didn't meet these conditions, then they will be deemed out of the regime. They are not part of the free zone. They are not unqualified within the free zone, and they will be unqualified from the beginning of the current period, tax period, which they unqualified for, and the 4 subsequent tax periods.
And that would then mean that they are just subject to 9% as any other business in the UAE.
And that's mean, yes.
Okay.
Correct. And speaking of the qualified income, as I mentioned, because if you are a qualified free zone person, you will have a qualified income. This qualified income will be applicable to 0%. Would you tell us know what is qualified income?
Yes, so Hani, thank you. So qualified income can be split into 4 buckets. So the first bucket is income derived from transactions with other free zone persons, where the other free zone person is the beneficial recipient of the goods or services being provided, and it's not in relation to excluded activities. Some of the excluded activities are most transactions with natural persons, so individuals, banking services, insurance services. This excludes reinsurance services or captive insurance services. The exploitation or ownership of intellectual property, excluding qualifying intellectual property, which I'll touch on in a moment. The second bucket is income derived from transactions with non-free zone persons in relation to qualifying activities. And it can't relate to excluded activities. Ministerial Decision number 265 of 2023 lists out all the qualifying activities. Some of the popular ones we're seeing in the UAE relate to headquarter services to related parties, treasury and financing activities to related parties, distribution of goods in or materials in or within a designated zone. And these designated zones are the zones for VAT, and trading of qualifying commodities. The third bucket relates to income derived from the exploitation or ownership of qualifying intellectual property. Qualifying intellectual property relates to patents or copyrighted software, but it doesn't include trademarks. And the fourth bucket, so under the regime, the free zone regime, they will allow you to earn other income, and they call it non-qualifying revenue. But this non-qualifying revenue must meet the de minimis test. And the de minimis test says that your non-qualifying revenue should be the lower of 5 million dirham or 5% of total revenue. And this is kind of one of the most important conditions, because if a business fails to meet any one of the conditions, but specifically the de minimis test, they will be banned from the free zone regime, as Hani rightly said, in that current tax period and the subsequent 4 tax periods. So it's really important for businesses to understand, who are they transacting with? Is it free zone persons? Is it non-free zone persons? Where is their income coming from? And understand, will they be able to benefit from the free zone regime?
So before we go ahead, just maybe to illustrate this with an example. So let's say you have a company in the free zone, and let's assume that they meet all the other requirements, and then we look at the income. And then the de minimis test, I think, means that you have qualifying income and you have other income. And that other income, that can be maximum a certain percentage. Or so that's the 5 million or the 5 million dirham, or 5% of the total revenue. So if it goes above that, then the consequence of that is that all the income is taxable against 9%. So there is a small margin of error, and I think that's what the de minimis test is. Is that right?
Yes, yeah. Businesses really need to look at, yes, you may have qualifying income, but if you have other income, do you meet that test? That is the key, because again, as we rightly said, you'll be out of the free zone regime for 5 years, and that is a long time.
Yeah,
that's a long time.
It's a long time.
So which revenue streams, and this is perhaps a good question for you, Hani, are excluded from the total revenue and the non-qualifying revenue calculation, and therefore taxed at 9%?
Yes, of course. That's a really good question. And as Alexandra and you've mentioned, Tim, about the de minimis test, we need to know what is excluded from the calculation of that de minimis test. I mean, the ones that will be excluded, or the revenue streams that will be excluded from the calculation or from knowing the de minimis test, will be revenue from domestic and foreign permanent establishments, and also revenue in relation to immovable properties. But we need to exclude commercial properties, which are dealt between the free zone persons. And of course, the free zone person will be the beneficiary of the service that's been provided. And the last one is the revenue from the intellectual property. But of course, excluding the qualified intellectual properties. Now, all of these revenue stream will be taxed at 9%, and the 0%, which is from 0 to the threshold for the 375,000 will not be applicable in this case. So they will be taxed at 9% in total. If you have a qualifying income and other income, what is the interaction, Tim? What is the interaction between 0% and 9%?
Yeah, good question. Maybe I explain it step by step. So how I would, and that's what we do for our clients as well, how we look at it. So first, you look at the total P&L of the entity, of the free zone person. So you look at what's in the income statement. Then you exclude the types of income that you just explained. So then what remains, you go on a line-by-line basis. You're going to check income from each type or activity. You check if that is a qualifying activity or not, if that's necessary. If the income is from another free zone person, it's sufficient if the income is not from an excluded activity. So let's say that income is either from a free zone person and not an excluded activity, or it is income from a qualifying activity. Well, that is basically the good type of income. So you look at all of the P&L, you look at the numbers, and if you can substantiate that whatever is not in those buckets is less than that 5 million or the 5% of the total revenue that Alexandra talked about, the de minimis test, then all the income, including also that small part which is not necessarily in the right bucket, becomes taxable against the 0% rate. If we go above the de minimis test, or we have too much, so that means we have too much non-qualifying income, then all the income will be subject to 9%. So it's not that you have the 0% rate on the qualifying income and the 9% on everything else. No, you look at it, first you exclude the categories that you just explained, Hani, the excluded activities, but then it is a all or nothing. So with a minimal margin of error, and that's the de minimis test. In your experience, is it always better for a taxpayer to be subject to the 0% rate? Or could you also think about instances where it might be beneficial to be just taxed as for example, a mainland company and therefore being taxed at the 9% rate?
Yeah. So, Hani, do you want to start us off?
Yeah, of course. I'm happy to do that. Thank you, Tim, and thank you, Alexandra, for the opportunity as well. Yeah, for sure. I mean, there are benefits, of course, if we're talking about free zone, qualified free zone person compared to mainland entity, let's say, that is not within the free zone regulation regime. I mean, if you want to look at an entity that let's elect to be subject to corporate tax, and elect to be subject, to 9%, then that entity is looking mainly to look at if they want to benefit from the available reliefs that are not applicable to the qualified free zone persons. And those relief would include, for example, if they want to apply the small business relief or the loss reliefs or try the reliefs in relation to the transfers within the qualifying group. In addition to that, which is well known as well, and it's talked about a lot, is tax group. So if you want to form a tax group, you cannot form a tax group if you are a qualified free zone person. So maybe they opt out of the CT regime of the 9%, so that of the qualified free zone person, so that they can form that tax group or be part of that tax group.
Yeah. And
is there any? Do you want to add any other thing there?
In addition to that, so as people should be aware, the UAE will be introducing Pillar 2 in 2025. So some businesses operating free zones may also be subject to the top-up tax of 15%. So actually, the benefit to them of opting out is, yes, they may not qualify for the 0%. Well, they may qualify for the 0%, but they will only benefit for 1 year. So it might be easier for them to opt out and prepare for Pillar 2, especially as there's an additional cost to being a qualifying free zone person. You need to prepare audited financial statements, so therefore you need to pay for an auditor. There are additional transfer pricing requirements if you're large enough, where you have to prepare a master file and local file. Again, this is advisory fees. So actually, it might be beneficial to opt out of the regime, where you want to benefit from the tax reliefs, you want to form a tax group, or you potentially may be subject to Pillar 2.
Yeah, so let me summarize that just to confirm my own understanding. So we have a favorable free zone regime. So if you conduct the activities that are qualifying activities, you have the benefit from the zero. They have the opportunity to benefit from the 0% rate. But you always have to look at all the other options as well. So there are also other incentives, such as the small business relief. So if you're still below the revenue threshold for the small business relief, then you can also have a tax efficient position until the moment that the small business relief phases out, 2026.
Correct.
Grouping is available for non-free zone companies. So there's free zone persons which are not qualifying free zone persons. They can also be part of a group. And then you can form a tax group, and then you have a compliance benefit, because then you only file one tax return instead of for each and every single entity you file one. Exactly. So I think if we all want to bring it together, it really depends on the facts and circumstances of the taxpayer. If they want to go for the free zone regime, or they want to go for the corporate tax grouping regime, maybe even something else. So therefore, I think we need to advise our clients, and I think that we're doing is look at it holistically, and see what works out best for you, and then optimize for that position. Is that a fair understanding? And noting one more thing, and that is this: you mentioned Pillar 2, but that's the global minimum tax of 15%. And what that then means is if you are in scope of Pillar 2, and we can do maybe another podcast on Pillar 2 once, but that means that if you're a multinational group, and if your revenue is above 750 million euro per annum, you come in scope of Pillar 2. And that means that once Pillar 2 has been introduced, and that might be anticipated because that is globally happening, as we know, then you might see an effective increase of the free zone rate from 0% to 15%, or perhaps a little bit lower because you have the substance-based carve-outs. But at least it might be higher than 9%. So then that means then that the net effect of the free zone regime is smaller, because you have more top-up tax in a free zone situation compared to a mainland situation.
So Tim, now corporate tax is in full swing. What are we seeing in practice here in the UAE?
Well, ideally, clients have already undertaken their corporate tax impact assessment. So then they basically look at the tax position, how the rules apply to them, what opportunities do they have, what elections are available to them, are they a qualifying free zone person, or are they subject to the 9% rate, what are the tax grouping options. So they work through all these decisions that they can make and all these options available in the corporate tax law. When I say options, then that might imply that you make changes to the structure. You can make some change to the structure to get better tax outcomes, but you should then also observe the general anti-abuse rule, which says that if the only reason why you make changes in your structure, if that's to get better tax outcomes, well, that's not valid. So you need to have valid commercial reasons, bona fide reasons. If you make changes for bona fide reasons and you have better tax outcomes, that should be permissible. But if you only do it for tax reasons, that's not permissible. So you should always operate within the boundaries of what's permissible. Another point where we help clients is to see if their IT landscape is ready for corporate tax. For corporate tax, as well as for Pillar 2 reporting later on, you will need to have a lot of data points that you need in your corporate tax return. It is possible that there might be data points which a finance team doesn't have. immediately access to. For example, information about shareholders or information about transfer pricing that is at the group level. If the taxpayer is a local opco of a foreign group, so there could be many data points. And then what we then do with our clients is we work through to see what is already available in terms of data and what and where there is a gap. Then how are we going to fill that gap? What we try to do immediately is also think about the future. About we know from the Pillar 2 legislation what likely data points are for Pillar 2.
Thanks for sharing, Tim. I think to reiterate, it's very important for businesses to really make sure they're ready for corporate tax.
Exactly.
Make sure their IT systems, all the data points, they have the financial information to prepare their financial statements.
Exactly.
A lot of businesses may never have prepared financial statements before.
Yep.
If you've not done an impact assessment, please do one to understand your position and think about the future. If you're going to be subject to the Pillar 2 rules, do start early.
Yeah,
exactly.
Yeah, that's absolutely spot on advice. Pillar 2 is a set of complicated rules, and it's not always easy to navigate. But I'm sure that there are advisors out there, including ourselves, that are happy to help whoever needs support. Yeah, that's a good note, perhaps, to end the podcast. So I hope it was an inspiring podcast. Hope that you all learned something about free zones today. We have tried to cover as much as we can, but we couldn't cover everything. So if you have any questions, then feel free to reach out either in the comments below or just directly on our landline or email address. Thank you so much for being with us today and have a great day.